Everyone, and thank you so much for joining us for week 4 of our 4-part summer webinar series. I'm today discussing a case for Roth contributions. So before we jump in today, a couple introductions. Mr. Mike Albee.
Thanks, Chad. Hey, everyone. I'm Mike Albee. I'm a senior portfolio manager and certified financial planner at BFSG. I've been here for a little over coming up on 16 years, I think it is now. I look forward to diving into some of the case studies that we've got for you today and how Roth has changed with the Secure Act 2.0 that just passed.
And Mr. Arash.
Hello, everyone. My name is Arash. I'm a CPA and a certified financial planner. I'm one of the wealth managers here at BFSG, and I help our clients with financial planning and tax planning.
Thank you, gentlemen. And of course, you all know me, Chad Narani, a retirement plan consultant here at BFSG, working with their institutional clients and their 401k, 403b, and 457 plans. So first, I'm going to set the stage here. A little bit of back and forth between me and Mike, and then I'm going to let our financial planners here, Mike and Arash, get into a couple case studies looking through real life clients, right? Change the names, change the numbers a little bit. But really a case study for how contributing to the Roth bucket might actually impact your long-term savings and legacy planning needs. So first and foremost, what are the two traditional ways to save? Whether it's an IRA outside of your employer-sponsored retirement plan or inside of your employer-sponsored retirement plan. So first and foremost, the most common out there that most people are familiar with is traditional pre-tax contributions. What that means, pay no taxes today, reduce your current taxable income today, your money then grows in your account, tax deferred, and then when you take it out, you basically pay money on that account or pay taxes on that money at the time you withdraw it. So think of it like today you have a paycheck, you pay taxes as you earn money, your traditional pre-tax savings, right, become your new paycheck when you're in retirement, and you pay taxes just like you would today on that account. Now, the other way to save is Roth, which is after tax. Now, what that means for all of you unfamiliar with this is you pay all of your taxes today. The money then grows in your account tax-free. And when you're at retirement, you pay no taxes on that, right? And the reason for that is because you've already paid the taxes. The best benefit here, you pay no taxes on any of the earnings either, right? So that's the big difference from like an outside brokerage account you might set up where you buy and sell stocks or bonds, and based on short-term, long-term capital gains, you might pay taxes on the earnings. In your Roth account, no taxes on earnings ever. So an amazing benefit. Now, all things being equal, right? I want to just to set the stage. And I have some assumptions at the bottom of the page here. So just assume, right, the annual salary for this entire period for simple math is $100,000. We recognize most people will start, well below that, may never get there, may go well above that. But for simple math, assume somebody made $100,000 for their entire career, never went up, never went down, right? They saved in the middle of the page on the bottom, pre-tax annual deferral rate of 10%. Right? Now, if they save Roth instead, maybe they save only 7.5%. And the reason for that is that contribution effective tax rate at the bottom right is 25%. So I did just put the math, easy math at the very top, right? 10% pre-tax, if you weren't paying 25% taxes, equals $10,000. But if you take 25% taxes, that's $2,500. Let's reduce that to only 7.5% for Roth, because you're going to actually pay that $2,500 to the government today, which means you saved less into your account. Okay, now, very last line at the bottom of the page, the withdrawal effective tax rate for this example is also going to be 25%. I mean, your whole life, you basically pay 25% in taxes, whether you were working or whether you were in retirement. We're going to say that you make 7% per year, right, this entire period, and your income replacement need is only about 60% of what you make pre-retirement. Now, setting that stage with that landscape, traditional assets would grow over the course of that career, starting saving around 40, retiring around 70 to almost $1 million. And the money then on withdrawing would last you until around 96 years old, right? So a lot of people say, well, that's fantastic. That's great. Well, what happens if I do Roth instead? Well, again, you pay the taxes today, right? So you only save $7,500 per year into this account. That doesn't grow nearly as high, right? Only to around $700,000. But in retirement, you don't take any taxes from this account, which means it lasts until literally the exact same day, right? Because again, tax rate on the way in, tax rate on the way out, both 25%. Now, let's change this a little bit, because we know things are not always equal. So what if in retirement you have a higher tax rate? Well, all of a sudden, same exact ideas on the bottom, but if you look at the very bottom last line, that withdrawal tax rate in bold now moved to 35%, right? Maybe you're taking more money out, which means you move yourself to a higher tax bracket. Maybe things change and the government raises tax rates, whatever the case might be. You now paid 25% while you were working in taxes, but in retirement, your tax rate's 35% instead. So that pre-tax bucket still grows to the same place, right? Still 25% taxes on the way in. But on the way out, paying 35% instead of only 25%, that money will only last you until the age of 89. Now that Roth bucket, 25% on the way in, all of your taxes paid didn't change. Still lasts you until age 96, right? So again, now this could work the opposite. I don't actually have a chart to show, well, what if your tax rate was lower in retirement, which might be the case for many of you as well. And if that was the case, then all of a sudden the gray bar would have extended even further because you paid less taxes in retirement than the blue line. So a lot of things to keep in mind, but again, all else being equal, like what's the reason that people are talking about Roth? What's the reason it's so popular? This is the idea. You pay taxes today, you never pay taxes again. So Mike, I'm going to kind of summarize real quickly, right? Pre-tax contributions, tax deductible today, earnings compound, tax deferred, you pay taxes at retirement. What are times when somebody would use this?
Yeah, and just to make sure everyone is clear too, the taxes on the way out are ordinary taxes, whatever your tax bracket is. And that example Chad was giving, we just use 25%, but you could be in a higher tax bracket. But pre-tax, I mean, if you think your tax rate will be lower at retirement, then it makes sense to make pre-tax contributions, especially if you're a higher earner. It may make sense to while you when you retire, you could be potentially in that lower tax bracket. Also, those pre-tax deductions reduce the amount of income you have to pay taxes on. Again, another bonus for those higher earners or others needing tax savings today.
Yep. Thank you, sir. So the next one, right? So again, Roth, just to summarize before we get into some of these case studies, right? Not tax deductible today. You're going to pay all the taxes, but then qualified withdrawals are tax-free. So there's two caveats we do have to give you here. So the first one is that Roth contribution has to have been made at least 5 years prior to when you want to distribute that. The reason that we like to give this example is assume you're age 62 or 63 already, and you're looking to retire in 2 years. You don't have any money in your Roth account. If you drop money into a Roth account today, you will still need to wait 5 years before you can touch that money, right? That account has to be open for 5 years, regardless of when you retire, right? So at a very minimum, maybe if you're under the age of 60 and you're still planning to retire at 65, at least open a Roth account. That gives you a lot of flexibility, and that 5-year clock will be over by the time you reach there. The next caveat is, and this is similar to, right, pre-tax money too, you still need to be age 59 and a half to touch any, right, tax advantage retirement account, pre-tax or Roth, unless you've basically had all of the worst things in the world happen to you, right? Disabled, death, etc. So again, 59 and a half, and at least needs to be open for at least 5 years is the big caveat for Roth contributions. But assuming you meet those two, right, Blue, you don't ever have to worry about tax rates on your Roth account or future tax rates in your Roth accounts. So Mike, what are the considerations, or who should really consider Roth accounts?
Yeah, I mean, anyone who has a long runway until retirement, especially younger clients who hopefully have expectations of future income growth, are going to want to favor Roth accounts. Also for, I mean, the wealthy, it's a really good wealth transfer vehicle for estate planning purposes. And it's also could be a hedge on future tax rates. We don't know what taxes are going to do in the future. The Tax Cuts and Jobs Act is going to sunset in 2026, and those tax rates, unless Congress acts, will be going up. But a Roth can act as a tax hedge as well.
Yeah, I love it. It's this idea, if you don't have any Roth money, right, figuring out a way to accumulate some right before retirement is, probably a good idea. Okay, so let's move on. Like that's basically setting the stage. Now, let me turn it over to our financial planners, Mike and Arash, to really lay some groundwork for us.
Yeah, so I mean, we're going to cover what I just kind of summarized with both pre-tax and Roth, but looking at it in a graph. So let's take a look at this chart. On the horizontal axis is age, on the vertical axis is your taxable income. And so as I previously mentioned, typically when you're just starting your career, your earnings are likely lower. And at this stage in life, you may want to favor after-tax accounts such as a Roth 401k or Roth IRA or Roth 403b. That's that kind of blue shaded region. And then as we go up the curve on this chart, or as one gets older and earnings continue to grow, depending on your specific situation, and we're going to look at some case studies later, it may make sense to do both pre-tax and after-tax contributions. And then towards the end of your career, in your peak earnings, you need tax deductions. It probably makes sense for a lot of people to make pre-tax contributions as reflected in that kind of gray region. So this is, I mean, just there's everyone's situation is unique, but this is what we often see at kind of different life stages. And then when you retire, your income drops potentially, which is that number 2 there on the screen. And before you have to start taking required minimum distributions from your accounts, there may be a window where your income's lower and we can look at Roth conversions, which we have a case study later on and we'll dive deeper into. And just remember, required minimum distributions, now for anyone who's going to be starting them this year and afterwards, start at age 73 and eventually move up to 75. That was with the Secure Act 2.0.
Great, thank you, Mike. So our goal today is to really shed some light on the benefits of Roth retirement accounts and the ways it could help you be better prepared for retirement. So the main reason that Congress passed this to establish Roth accounts was to help hardworking middle class Americans to put money away tax-free. So here are the key benefits that Roth retirement accounts are attractive. So the first one, which I think we mentioned a couple of times, is tax-free distribution after 59 and a half. So as we repeated a couple of times, since you put money into Roth accounts with after-tax money, so basically you pay the taxes, you put the money into the Roth accounts, in retirement after 59 and a half, and you start taking money out, you don't have to pay any taxes on it. And this money basically grows tax-free. And this is very attractive, especially nowadays that people are living longer into their 90s, because you can leave that money in there, let it grow and compound year over year, tax-free, and it can be a great resource for you. And the second point that a lot of people are actually unaware of is that you're able to access your contributions before 59 and a half without any penalties and taxes. So there is a younger crowd of people who don't want to put money into their retirement accounts because they think they want to retire earlier, and then they wouldn't have access to 59 until 59 and a half. But the reality is with Roth IRAs, the money that you put in is accessible. It's only the earnings that you could get hit with penalty and taxes if you decide to take it out earlier than 59 and a half. So that makes this account very attractive because you always have access to your contribution. And another important piece when it comes to Roth accounts is the required minimum distribution. So basically, there is no required minimum distributions for Roth retirement accounts. Required minimum distribution, that also is commonly known as RMDs, is a requirement by IRS that individuals over age of 73 that have to start taking money out from their pre-tax accounts. So those accounts, the regular 401ks and traditional IRAs where you put money in before taxes. IRS basically wants to collect their taxes at some point. So they're forcing people after age 73 to start taking a specific amount out and pay taxes on it. But with Roth, you already pay taxes. So there is no requirement to take money out and pay taxes because there is no taxes to be paid. So this makes it very attractive, especially ties into our next point about legacy planning. Because there is no taxes to be paid and there is no RMDs, especially now with Secure Act 2.0, rules have changed. So legacy planning really goes back to leaving money to your beneficiaries. Some rules recently changed where your beneficiaries of your retirement accounts, such as your traditional IRA or 401ks, will have to deplete those accounts within 10 years. But if you have a Roth account and you pass it on, then those beneficiaries don't have to worry about paying taxes. Because in a lot of cases that we have seen with our clients, people inherit these type of accounts in their high earning years. So what happens is that within those, if they have to take those amounts out within 10 years, their income goes into a higher tax bracket and have to pay more in taxes. But if you have a Roth account and you pass that on to your children, then they don't get hit with the higher taxes, and they don't have to worry about paying more in their high earning years. And in addition to that, this really comes back to tax diversification that we mentioned. We don't really know where taxes are going, but in my personal opinion, with the way the government's spending money, either tax is going to go up or some inflation is going to happen. And we saw what happened yesterday with US government debt getting downgraded because people are getting worried about the overspending and everything. And this could potentially lead to higher taxes down the line. So if there is a way to hedge against higher taxes, such as paying some taxes now, letting the money grow tax-free and don't worry about taxes, I think it's a good way to do this. So I would think people should take advantage of this retirement account as well. I think it's a great way to do diversification when it comes to taxes and hedge against higher future taxes.
And Arash, I want to just point out a couple of things throughout the presentation. There's going to be in blue font that Secure 2.0. Those are rule changes that just happened at the beginning of this year. Previously in Roth, in-plan Roths like a 401k, 403 or 457 plans, you were required to take required minimum distributions. They've done away with those now, so they're in line with the Roth IRA. So there's no RMDs. There was a loophole you can get around that anyways, but we don't have to worry about that today. So throughout the presentation, you'll see Secure 2.0. Those are new rules, and we'll highlight those as well. But yeah, there's plenty of reasons why we're making the case for Roth as highlighted here. And let's dive into some of the case studies now.
Great. So on the first case study, to help kind of demonstrate some of these benefits, we're going to talk about two couples here, a couple here, John and Jane. They're in their 30s, and they have a combined income of about $240,000. They're planning to retire at around age of 65. And based on our software and the statistics that we see, we expect them to live into their 90s. And they also have a son who's 6 years old, so they're saving money for their kid college tuition as well. So as we can see on the next slide, here is their balance sheet. So they basically have their savings and checking accounts. So that's where they keep their emergency cash that they need and also pay their expenses. They have a Fidelity brokerage account, for example, where they put their excess cash to put into investments, and they're now building up their 401ks. And their main asset right now, which comprise of their 80% almost of their net worth, is the real estate that they purchased a couple of years ago. They got lucky right before the pandemic, so the prices went up, and they have a low mortgage here. So their main goal at this point, now that they also have their real estate, is to really build up their 401ks and save for retirement. So when it comes to financial planning, we have to do some assumptions. And on the next slide, we can see that for this couple, they're contributing about 7% into their 401ks. They're both making the same percentage, and their employers are matching about 4%. So again, when it comes to financial planning, we have to make some assumptions about rates of return, inflation, and taxes. So for this couple, we have 5.55% for rate of return. This is conservative. We always want to be conservative, just because we don't know how the market is going to react over the years. And then we have inflation at 3%, and they're currently in the 24% tax bracket. So our goal here with this financial plan was to take a look at their current scenario where they continue to contribute this percentage to their retirement account and see what happens over the years with their net worth and expenses and income, and at their life expectancy at the very end. And also we wanted to do a scenario. So what happens if they take advantage of a Roth 401k account? So they make 100% switch and put all their contribution, that's 7%, into a Roth account instead of a pre-tax account. So that was our main goal here, just to show them what their net worth would look like at their life expectancy. So on the next slide, we can see this, how this played out. So on the left-hand side, we have the base case scenario where they continue down the path they're currently in and they contribute that 7% to a pre-tax account. And they're going to end up at their life expectancy in year 2083 with $11 million in assets. So about $7 million in their investment portfolios, in those retirement accounts. And that's a nice chunk of cash. But if they had done it in our scenario where they switched to a 401k with this Roth 401k, they would have end up with $14 million in assets and about $10 million in their portfolio of assets. So they would have had $3 million more. But I just want to point out that as we went through the numbers, we could see that this couple early on, they would have had more money on the current path that they were on because they weren't paying any taxes. So they had more cash on hand. They didn't have to pay taxes. So in their investments were growing more. But what happens is that in retirement, once they need their access to their retirement accounts, once they have to start paying required minimum distribution, they had to pay a lot of taxes. So they ended up depleting the pre-tax accounts much faster. But in the Roth scenario, that money was tax-free. They didn't have to pay any more taxes, so allowed it to grow much faster down in retirement. And that's where it really took off in retirement because it's tax-free money that you have in the Roth. And that's really where the advantage of Roth accounts played in for this couple. And lastly, in this case scenario, on the next slide, we can really see the tax diversification benefit that we talked about. On the left-hand side, and if they continue down this current path, they would have left about $7 million for their son. About 64% of that would have been in tax-deferred accounts. Again, this is the account where they didn't pay any taxes on it. So every time they take money out, they have to pay taxes. So their son would end up having to deplete that account within 10 years. And every year that he takes money out, he would have to pay taxes. And he might be in his high earning years, so he's going to get pushed up to a higher tax bracket. But in the Roth scenario, that is a tax-free money. Not only would he get $3 million more, it's also tax-free. So he's going to substantially benefit from this decision that their parents made. But I want to point out that this kind of worked out for this specific couple because of their income, expenses, and cash flow and their needs in retirement. And every scenario is different. So this doesn't mean that everybody on this call should tomorrow go switch 100% to a Roth account because your scenario could be different. It really comes down to your cash needs. So this couple, for example, had the cash to pay their taxes upfront, but some people don't. And some people could be in a tax bracket that doesn't make sense for them to put money in the Roth at this point in their life. So it really comes down to your specific scenario. And you should talk to an advisor, a planner, help you make that decision. And
thanks, Raj. So let's jump into case study number 2. So if you recall on the prior slide I went through of the graph showing kind of different age brackets of when you should consider pre-tax and after-tax, and then at retirement, there was a drop of income potentially before Social Security kicks in if you're delaying it, and or those required minimum distributions at age 72 through 75, depending on your age. So let's look at a case study involving that Roth conversion. A Roth conversion occurs when you move pre-tax assets from like a traditional IRA, SEP, simple IRA, or one of your employee-sponsored retirement plans like a 401k. When you move money from one of those pre-tax accounts to a Roth IRA, and you pay taxes on that converted amount, and that's ordinary income taxes that you're paying on that converted amount. There's at least 5 well-established advantages for converting retirement accounts to a Roth IRA. One is future tax-free earnings, future tax-free withdrawals, 3 penalty-free withdrawals, as long as you meet those 2 requirements Chad talked about, 59.5 in the 5-year hold period, no RMDs, and then future tax-free withdrawals for your heirs, which Roth just showed you in that other case study. So conventional wisdom is that a Roth conversion should be considered if you anticipate being in a higher tax bracket in retirement. But is it really that simple? So let's dive into Paul and Melinda Jackson's information. So when we look at Paul and Melinda, they're in retirement. They're both age 68. They have income coming in from Social Security and pension. They take the standard deduction, and then they don't have to start taking required minimum distributions until age 73. And so when we look at again, another assumption we have to make is life expectancy. No one has a crystal ball, but we're assuming age 90. So when we go and look at their savings, most of their savings are tied up in their home or tax deferred accounts. They have no really tax diversification, no tax-free accounts or taxable brokerage accounts. And so when we looked at that, we said, okay, how can we start creating some of that tax diversification? And we wanted to look at Roth conversions. So if we go to the next slide, we're going to run that scenario analysis as well. So on the left-hand side of the slide is their base case. They continue down the path they are. They do no Roth conversions. And based on their spending and our asset growth assumptions, they don't spend down their assets, and they're projected to end up with more assets at the end of their plan than today. However, their tax deferred assets went from approximately 27% of their assets today to around 4% by the end of the plan, because they were required to take that money out each and every year. And along the way, they're paying taxes. For them, they were in the 22% federal tax bracket, and they had to pay state as well on top of that. So some of those assets their heirs are going to inherit, and they're going to have to pay taxes on over that 10-year period. They're going to have to deplete those accounts. So then what we did is said, okay, you guys are going to have money left over your plan. You can either spend more, or if you wanted to leave assets to your heirs tax-free, let's run a scenario, which is on the right-hand side of the slide, where they convert approximately $38,000 per year over the next 5 years before RMDs kick in. This conversion amount, $38,000, keeps them in the 22% tax bracket. That's something you really want to pay attention to when you're doing a Roth conversion is it going to be bumping you into a higher tax bracket? Because again, it's treated as ordinary income. So you want to be aware of tax bracket management when you're doing that Roth conversion. And so what we looked at is, yes, they're still paying 22% on that conversion today, but because they're getting tax-free compound growth each and every year until the end of their plan, their total portfolio assets are higher by about $200,000. And then that created tax-free withdrawals for their heirs. To just illustrate that on the next slide, you'll see that the tax-free assets on the slide on the right, and along with their taxable assets in their house, I mean, their heirs are getting everything. The taxable assets get a step up in basis, their house gets a step up in basis, and then the Roth accounts all tax-free. So it's a great legacy planning tool, as I mentioned previously. Since this couple were not spending down their assets, and they got tax-free compounded growth over that period of time over the next 20 plus years. The other thing I want to point out too is, as I mentioned, this could change depending on your tax bracket. We were able to keep them in the 22% tax bracket. The outcome could have changed if they were at the threshold bumping into a higher tax bracket. The other thing is your modified adjusted gross income for Medicare Part B and Part D. There are certain thresholds that if you go over those, you have a surcharge on Medicare. It's called the Medicare Income Related Monthly Adjustment Amount, or IRMA. And so anyone, a single individual making above 97,000, or for a joint return 194,000, you don't want to go over those amounts, or you at least have to be aware, because your Medicare IRMA could go up for Part B and Part D. So those are other factors that you want to consider when you're doing a Roth conversion. So looking at the next slide, really this is just an example. We're done with the case studies, but I want to make sure that everyone's aware that a Roth conversion is not an all or nothing event. You can do it over time. You can do any dollar amount each and every year. You don't have to convert it all at once. And so we wanted to show kind of worst case situations of someone just deciding to do it all at once. And in this case, we're just looking at someone with a salary of $80,000. They're in an effective tax bracket of 22%, and they take their entire Roth IRA and do pre-tax IRA and do a conversion to a Roth of $200,000. Their taxable income, again, that's all treated as taxable income. So now they're at $267,000 approximately after deductions, and their effective tax rate federal goes up to 35%. They would pay $70,000 for that conversion. And ideally, funds should come from sources other than your account to maximize the conversion benefits. You want to pay out of pocket for those. So again, we just don't want big surprises like that. And again, bumping you from a higher tax bracket of 22 to 35 in this example. If we look at even a larger amount, let's move to the next example. We took someone with a salary of $400,000. They're already in the 35% tax bracket. They convert their entire IRA to a Roth of 1.5 million. It bumps them a little higher into the highest tax bracket at 37%. But we just want to show you for kind of big numbers, paying out of pocket almost $700,000. That's a giant number. So again, Roth conversions, make sure you have the cash available to pay those taxes up front. They should not be coming out of the account.
Let me make one important note here, I think, is why this slide is so impactful is number one, Mike's talking about like tax planning, right? Work with your financial planner, work with your accountant, and make sure you do this, periodically over time. The next one though is there's a lot of red flags when you're going through these things, especially if you're doing it from like a 401k or employer-sponsored retirement account. They're going to red flag you all over the place to make sure you understand that this is an irreversible decision. So if you accidentally just convert that $200,000, right, the IRS is going to come knocking for that $70,000 tax bill at the end of the year. So if there's something to keep in mind before you just go click buttons and start doing it, definitely reach out, talk to your accountant, talk to your financial planner, and make sure that you're doing it in the best and most strategic way possible.
That's a great point, Chad. It's definitely a great strategy to have when it's done properly, when you do it in a year that you're low in taxes and you're not getting hit with a lot of taxes, because you can convert a nice chunk of money from pre-tax to post-tax at low rates.
And we always work as a team. I mean, we've got in-house CPAs, Arash being one of them, but we work with our clients' tax professionals as well, just because there's so many moving parts and it's such a big factor. So it's really important to involve your tax professional.
Great. And now we're going to talk about a topic that comes up quite often with our clients, is the contribution limits. How much can you put money into the retirement plans and IRA accounts every year? When it comes to contribution limits, they are the same for traditional pre-tax account and the Roth contributions. So for 2023, an individual can put away $22,500 into a retirement plan at work And if you're over the age of 50, you can put a catch-up contribution of $7,500 for a total of $30,000. So the catch-up contribution again comes back from IRS, recognizing that people over 50 are getting closer to retirement. So they want to provide you some opportunity to save a little bit more for retirement. So that's where that catch-up contribution comes from. And for individual retirement accounts or IRAs, annual maximum contribution limit for 2023 is $6,500. And for those over 50, they can put an additional $1,000 in there for a total of $7,500. Just want to point out a couple of items here when it comes to contribution limits. One, which is the most important one, is that you have to have earned income to be able to put those contribution limits into your retirement accounts or individual retirement accounts. And earned income means that you have to actually earn that money. So let's say if you had a part-time job and you only made $5,000, you can only put $5,000 in an IRA account. You can't use the additional money that you have in a savings account to contribute into an IRA account. You can only put up to your earnings. So I think that's an important point there.
And Raj, just earned income too. I mean, if you're unemployed, that is not earned income. If you're taking a required minimum distribution from your IRA account, that is not earned income.
Great point, Mike. And also the combined traditional Roth contributions cannot exceed those limits. So you can't put $6,500 in a regular IRA and $6,500 in a Roth. If it's the combined amount has to be matching that amount. The same for the retirement plans at work. The combined contribution to a pre-tax and a Roth cannot exceed the $22,500 if you're under the age of 50. And lastly, employer contribution in retirement plans always go to the pre-tax account. So let's say you have a pre-tax and Roth accounts at work and you're putting all your money into a Roth, your contributions from your employer will always go to the pre-tax account. Although recently things have changed with Secure Act 2.0 and we're waiting for clarification to see how that progresses. So that may change in the future.
And I just want to point out on the contributions. So when we say retirement plan, I mean, think 401k, 403b. A lot of those plans nowadays have a in-plan Roth feature. And whereas a Roth IRA or a traditional IRA, the limit is $6,500 or $7,500 if you're over age 50. So a Roth 401k, you can contribute a lot more to if your employer provides that feature. So it's a big benefit if you've got that in-plan Roth feature.
Definitely. And if those rules weren't complicated enough, there are some additional rules when it comes to income limits on the next slide. So IRS have specific guidelines when it comes to how much money you can put away into individual retirement accounts. So this slide is all about IRAs, and it's not talking about your retirement plans at work. It's just your contribution, the amounts that you can contribute to individual retirement accounts. So if you're covered by a retirement plan at work, you can still put money into a traditional IRA account up to that $6,500 that we talked about in the last slide. But the fact that if you can deduct it for taxes has to do how much income you make. So if you're a single individual in 2023 and you have a retirement plan at work, if you make less than $73,000, you can put in money into an IRA and you can deduct it for taxes. But if you make more than $73,000 to $83,000, then there's only a portion that you can deduct. And if you make more than $83,000, you can't deduct any of your contributions that you have made to an IRA for tax purposes. And for married couples, we also have those income limits there. And if your spouse has a retirement plan at work, but you don't, IRS recognizes that you're at a disadvantage, so they have a higher income limits. This can get a bit tricky, so you might want to talk to your accountant or a financial advisor to help you understand these. So if you are contributing, you're making the maximum benefit from it. And then on the right-hand side of the slide, we have the limits, the income limits for a Roth IRA contribution. Again, Roth IRA is with after-tax money, so the question here is whether or not you can deduct it for taxes, but really if you're allowed to put money in a Roth IRA account. So If you're single individual in 2023 and you're making less than 138,000, you can put money into a Roth IRA account. But if you're making between 138 to 153, you can only put a proportion of that 6,500 in a Roth account. And if you're making more than $153,000, IRS thinks you're making too much money. You shouldn't be taking advantage of these accounts, so they don't allow you. And if you put money in there, you're going to get penalized every year for about 6%. And then we also have the married couples income range here as well, 218,000 to 228.
And to add additional complexity to this, there are ways around those Roth limits. If you're really wanting to make a Roth contribution and you're making too much, you can do something called a backdoor Roth contribution, where you make a contribution to your traditional IRA and then convert it to a Roth right away. So there are some kind of loopholes, so to speak, to be able to still contribute to a Roth for those higher earners. But talk to, say, your tax professional or advisor.
Hey guys, I got two points I want to pull out. A couple of them coming actually from the Q&A box, but I think it's going to apply when we get to our next slide too. But the first thing on this one is just to point out that this is specific to IRAs, right? Individual retirement accounts. All of these limits on this page do have nothing to do with your employer-sponsored 401k plan, 403b plan, or 457 plan. In those plans, it doesn't matter. You can make $20,000 or $20 million. You can always save to either the pre-tax or the Roth source. I was working with a client just the other day that we've been working with for over a decade and still did not realize that no matter how much money they make, they can always save into the Roth in their 401k plan. The other one is that, as much as we say your traditional pre-tax account or Roth account, in an IRA, you have separate accounts. There's a traditional IRA and you invest it right by itself. You might have a Roth IRA, you invest it yourself. In your 401k, 403b, or 457 plan, right, it is really one account with two money sources, right? So when you log in, you see one balance. Maybe it says your balance is $100,000. And then below that, you might see that you have $80,000 pre-tax and $20,000 Roth, right? If you save all Roth, now the Roth will start growing faster. But it is still one big retirement account at your employer's, within your employer's retirement plan. Technically speaking, most platforms like Fidelity, Schwab, et cetera, will allow you to invest different money different ways. So you can pick and choose how to invest Roth versus traditional if you wanted to. Although most people just invest them exactly the same, like all money sources invested the same. But just a couple things to clarify, because I think it can get confusing, right? In the IRA world, they are separate accounts. In your employer-sponsored retirement plan, it is one account with multiple buckets of money for you to invest however you choose. The next one is, or actually, it was back a few slides, but I just want to make sure we understand something. Did you say that withdrawals from a Roth 401k prior to age 15 and a half are not subject to the 10% penalty?
That was just Roth IRAs.
Right, just Roth IRAs.
Roth IRAs, yes, just Roth IRAs. Yes, it's a great point, Chad, because these rules can get complicated, and that's why it's important. If you ever have questions about your ability for Roth contributions or how your plan is set up, you should always reach out to us or your financial advisor to help you have a better understanding. Because unfortunately, tax system gets so complicated at times that it's easily that people get confused about their abilities to contribute and take advantage of these things.
So just to clarify, inside of your employer-sponsored retirement plan, before age 59 and a half, it doesn't matter if it's pre-tax or Roth, there is a 10% penalty. If you happen to live in California, by the way, too, I know we have a national audience, but for any of you in California, California actually imposes an additional 2.5% penalty. It is the only state out of all 50 that does that as of today.
The sunshine tax, right?
All right, gentlemen. Let's continue. So now that we've talked about the 10% penalty, we've assessed that it does apply. What are some of those exceptions?
Yeah, so let's get into those. Unfortunately, most of them you don't want to deal with. Death, disability, major medical expenses, IRS tax levy. If you're in one of those situations, sorry, and it's not typically reasons why you want to be avoiding the 10% penalty. There are other new features with the Secure Act 2.0 that just passed. They now make it available to have emergency withdrawal of $1,000 per year. That's not effective until next year, though. There's also disaster relief up to $22,000 available, where you avoid the 10% penalty. You can also pay for specified long-term care insurance premiums up to $2,500 per year. Again, that's phased in. It's not effective till 2025. This is not an exhaustive list. There are other 10% penalty exceptions. There's a link there that will be you can click on, and Chad will provide it as well in the follow-up email that goes out, providing what those other ones are.
So, and let me clarify something too. On those three that are effective because of Secure Act, right? The basically bright blue is anything that Secure Act 2.0 has made either like potentially required, if not optional. All three of these are optional in employer-sponsored retirement plans. So while you can do this into your IRA, just because Congress said you can do this does not mean your employer is going to allow any of these provisions into your 401k, 403 or 457 plan, right? I think a lot of some of our clients say that's great. It's employee money. If something happens, let them be able to do whatever they want. Others say this is really meant to be a vehicle. We're encouraging our employees to save for retirement. Why is Congress making it so easy for them to take the money out for other purposes, right? And so, okay, just things to be aware of. As much as legally these are now are becoming available, not every employer will actually put them into their plan document.
Yeah, and I think that's important, and it highlights the importance of having an emergency fund to avoid having to take an early distribution. While it's great they provide an emergency withdrawal relief, and again, if your retirement plan offers that, there are some other features that only apply to a retirement plan, like a 401k, a qualified domestic relations order. If anyone's unfortunately gone through divorce, that's when that applies. The other big one is the attainment of age 55 and separation of service. So you can avoid the 10% penalty, not taxes, but the 10% penalty from age 55 onwards. So that's great. And think twice about rolling over those assets to an IRA, because if you roll over from say a 401k to a traditional IRA, then you just increase that age of penalty free distribution from age 55 to 59 and a half. There are a few 10% penalty exceptions that apply only to traditional IRAs or Roth IRAs. Higher education expenses is one of them. That is not including student debt, though. First-time home purchase, only up to $10,000. I know at least here in California that might buy a cardboard box out on the street. And then payment of health insurance premiums for unemployment. So again, it gets complex. Some rules only apply to your retirement plan, some apply to a traditional or Roth IRA, some apply to both, and then some only apply if your employer makes those elections.
Great. Thank you, gentlemen. So as we wrap this thing up, just kind of think next steps. And I am right now for everybody here posting into the chat box a very long message with a lot of links. The first and foremost is a link to that 1 to 2 minute survey. But our team has also just from our blog put out a lot of different content on just Roth, right? Different reasons. Like, is it a good time for a conversion? Not a good time for a conversion? So just, how do you do the backdoor Roth? If that's something for all of you out there, I know Mike mentioned it. And some of the case studies and whatnot we talked about today got a little bit more complex than we usually do in these presentations. So we definitely encourage you to leverage some of these resources and do not hesitate to reach out with questions. We did put the contact information for Mike and Arash up on the screen, and you all have mine from all the emails that come out with the registration links for this presentation. Lastly, I know there are questions about, again, replays and the slides inside of the Q&A box. Replay links will be available for this via our YouTube channel. You will get 2 emails tomorrow, one from Zoom that will just have the replay link and the survey link. And then a second one will come from our team at BFSG that includes a link to all of the resources I just pasted into the chat box, as well as the replay link, survey, etc. So it will also have a link to the PDF slide deck that we use today, in case you just want to revisit and kind of flip through the slides and click on any of the links that were provided here as well. So with that, gentlemen, let me kind of get to the questions. I think as a reminder for the group, there's a Q&A box at the bottom of your Zoom menu. If you have any questions, we do encourage you to type them in. We will continue addressing questions for as long as we are receiving them. again, we always try to keep these to less than 1 hour, and we do recognize a lot of you have to drop in 10 minutes when we get to the top of the hour. But to ensure we address questions, we will stay on as long as it's needed. There's also a thumbs up box in the Q&A box for all of you. If you find a question that is something that you're already asking, please do just hit the thumbs up. I am actually going to ask questions based on the most votes, not based on when they were asked, to make sure I'm addressing the questions that you all find as most relevant today. So the first question I have up here right now is a Roth IRA the same as a rollover IRA? And that's a really good question. I mean, it can just take that one as no, it is not. So when you establish a Roth IRA, you're setting money and you're going to not get any tax benefit for that today. A rollover IRA would be like taking money from a retirement account, 401k, 403b, 47, et cetera, and rolling it into a separate IRA. Now that rollover IRA might be pre-tax and it might be Roth. That depends on what type of money you had inside of your employer sponsored account. So again, your rollover IRA could be pre-tax or Roth. It is not the same as just going to like one of your bank and just setting up a brand new Roth IRA.
Yeah,
the next question
to that, just quickly to add to that is that most cases a rollover is a pre-tax account. What happens is that when you roll money over from a 401k and you also have a traditional IRA account, you may want to keep those separated. So you open a rollover IRA, you put that money in there in case you want to put that money back into an ex-employer's plans. So sometimes they recommend that you separate those accounts from your traditional IRA accounts, which is pre-tax. So that's why there is a difference in names there.
Thank you, sir. The next question we have here is, we mentioned that 5-year rule. Does the 5-year rule apply from the date of conversion to Roth? Or if you already have a Roth account and you've had it for 5 years, from the first contribution, and then the conversions are just kind of like new? It's a great question.
That's a great question. No, it's on each and every conversion, the 5-year clock. So you got to know each conversion, again, why working and letting your tax professional know so they can track that. But yeah, it's on each and every conversion, that 5-year clock. It doesn't restart on the prior conversion, but say you do 5 consecutive years of conversions like we just saw in that case study, that 5-year is on each of those conversions.
Yeah, it's an important one. So the first dollar you put in and every other dollar you just put into your Roth IRA, right, if it's just a regular contribution, are subject to the original date the account was opened, right? So say you put $100 in from every paycheck into your Roth IRA, right? At the end of retirement, every contribution you made to that account that was not a conversion would be applied to that first day you opened it, right? That 5-year clock doesn't reset per contribution. Conversions are treated a little bit differently. It also, it's one of the things I talked about with my brother the other day. He's a CPA as well. And the thought was, if you're going to do a lot of conversions, is maybe just to bucket that out a little bit, set up a Roth IRA that's specific to conversions so that you can work with your accountants and kind of earmark and flag like a dollar amount in a year for each amount or each conversion amount. So you're not kind of commingling, right, these vintage IRA buckets with like an actual completely, call it vested IRA bucket.
Yeah, especially if you're thinking you're going to be withdrawing money, it's great to kind of segregate those assets if you need to. You don't have to, but it's easier from a tracking standpoint.
Yep. So next question we have here is, we mentioned that $22,500 or $30,000 is somebody could save in their employer-sponsored retirement plan. Those limits pre-tax, and the answer to that is it could be either. Actually, that could be either pre-tax or Roth or a combination of the two. So your $22,500 is if you're under age 50. Over age 50, with that extra $7,500 of catch-up contributions, you can save up to $30,000 in any 401k, 403b, or 457 plan. Now, that is, again, a combined limit. So you might say, I want to save all $30,000 Roth, all $30,000 pre-tax, or maybe $15,000 to both of them. Really up to you to pick and choose how you want to mix and match your money in your retirement plan. Next question I have here is, if I'm married or I have a spouse, joint income exceeds the limit that allows me to put money in a Roth IRA. Can my spouse still have her own separate spousal IRA, or will she also trigger a penalty because our joint income exceeds the limit?
If you're married, it would come off your joint income. So if it exceeds that limit, you're not allowed to put into a Roth account.
Yeah, just put that slide back on the page, just so you can kind of see that the IRA, either both actually, traditional and Roth IRA, you can kind of see right in the middle of the page the married thresholds if you're married filing jointly.
If your spouse does not work, he or she, there is no limit. Just wanted to point that out there. But if you're working and you're covered by a retirement plan, and they're working and they're covered by a retirement plan, then those thresholds apply.
Yeah, I think it's because just this middle, I want to make sure this is what Mike's talking about right here, so it doesn't get lost on the page. Just thinking about this, like there are limits that apply when you're both covered already by a retirement plan.
Yeah.
Okay, gentlemen, the next question we have is, I opened up a Roth IRA more than 15 years ago with a credit union. So obviously we're past that, it has a 5-year term. They're getting around 1%, currently valued at a little over $4,000. Doesn't mature until 2026. Do you think it's good just to leave it there? It's not a significant amount. And how much should somebody be contributing to this type of account every year? What I can tell you is this is going to be an "it depends" type of question. And, it's definitely something you want to reach out and kind of touch base with us separately. Because there's no way for us to tell, is that part of like a holistic bucket? How much other, resources and assets do you have as you plan for retirement? If you only have $4,000, I'd be contributing as much as possible for the rest of your career.
Yeah.
Yeah.
Go ahead, Arash. I'll add to anything you say.
So when I read this question, it sounds to me like that credit union is putting this money in some sort of like a CD or something, because you're saying that it's renewing. So you may want to talk to them, see what it is invested in, because it doesn't sound right. And you don't want to put, Roth IRA is meant for growth because it's tax free. So you may not want to put it in a CD. You want to put it in something that grows much more. So you may want to talk to them to see how it is invested. And we'd be happy to answer any questions you have after this call.
Yeah, that's exactly what I was going to say. We talked briefly about tax location strategies. In a traditional IRA or pre-tax 401k or something like that, it's growing tax deferred, but you want to keep any income generating, especially bonds which are tax at ordinary income, in those accounts. In a Roth, it's growing tax free forever, so you want to typically keep more stocks in that portfolio where you see higher growth. Putting a cash CD in a Roth probably doesn't make sense to maximize that tax-free growth. Yeah. And today, CD rates, you can get 5.5% instead of 0.95. So yeah, it's specific to your situation. Give us a call. We'll talk about it.
So the next question I have here is, what is the possibility of a change in rules currently set for Roth IRAs? As most specifically, what this one is any chance they ever add some type of tax at withdrawal?
It's always possible. I highly doubt they would change the rules for people who are already made Roth contributions, though. That would be more going forward basis on new contributions where they could change the rules. I think you'd have all these people that planned and did Roth contributions, and then they change the rules on you after you've made those. That I think you'd have a revolt, and I don't think that would happen.
It's exactly my thoughts too, Mike. They can't changing those rules. You never know what Congress would do, but changing the rules would be quite ridiculous and cause a lot of tension.
Yeah.
So the next question we have is, let's see, the bottom line, it's better to convert any non-Roth accounts into Roth monies so that our beneficiaries don't have to pay taxes when we pass?
Again, that's kind of specific to your situation. It's if you're wanting to pay those taxes for your heirs so they don't have to pay them, then yeah, but in that example I went through, they were in the 22% tax bracket. If you're in the 37%, do you want to be paying almost 40 cents on every dollar of conversion when your kids may be in a lower tax bracket and it's going to be less? It's just it depends. It's not a blanket conversion, but it is a good tool for wealth transfer.
Definitely a great tool for wealth transfer, the legacy planning we talked about, and also really, again, goes back to tax diversification too. You're diversifying your taxes because Mike mentioned the point about Medicare costs. And if you think about in retirement, some of the costs that you're going to incur has to do with your income. So the Medicare Part 2 premiums has to do how much income you're making. Same with how much of your Social Security is taxed. So by having a Roth account, it gives you tax diversification. So if you need money from one of your retirement accounts, but you don't want to increase your income, you can take money out of the Roth. So it just comes back to tax diversification, specific situation, but it's, with the way everything is, it's good to be diversified generally. So I think that is also a good point.
Yeah. And it helps. I mean, one of the things we didn't talk about, I mean, when you're taking distributions in retirement, and say in a given year, you have to take a larger amount out. We talked with a client earlier on remodels and the remodels running over budget and they need to take additional funds out. Instead of taking their they have to take the required minimum distribution, but anything above and beyond that, they're able to use their Roth and take tax-free money out, so it's not bumping in a higher tax bracket for that cash need. So that's what tax diversification is. They have multiple levers to pull to manage their tax brackets.
So the next question I have for you too, we got a lot of really good questions in here coming up, guys, by the way, is what are the limits for a backdoor Roth IRA contribution, or are there even limits?
There are no limits. It just comes down to the taxes that you have to pay. So if you do a backdoor conversion, it's going to increase your income and you're going to go into a higher tax bracket. So at some point, you have to evaluate, does it make sense to pay this much taxes and do a conversion or not?
It's not contribution. So yes, there is. You still cannot contribute more than $6,500 to a backdoor Roth. So it's not conversion limit, it's a contribution limit.
Oh,
yeah. I may have misheard the question. Sorry, I don't see.
Yeah. Contribution, there are limits still. Those same limits.
I heard backdoor conversion. Sorry, that makes sense.
I might have said that. So yeah, it's still 6,500. The normal limits you have that you really contribute to a non-deductible IRA and then convert it over immediately without ever investing it. So there's no earnings. Is an easy way to get an extra $6,500 into a Roth IRA. Again, inside your 401k, 40347 with your employer, if they have Roth available, you can already save up to $22,500 or $30,000 without using any backdoor mechanisms, which is an amazing tool already.
Yeah, and one thing, I mean, with the traditional IRA, what we see on this screen here, I think there's always confusion around it. You can always make a traditional IRA contribution. There are no income limits. The income limits apply to, is that contribution tax deductible or not? So when we show these thresholds here, that's for tax deductibility. So if you're over those limits, you can still make a traditional IRA contribution. It's just not tax deductible, and then do that backdoor Roth, but it's still up to those limits.
So the next question, and yeah, I feel like we might have already addressed this, but because I think we've talked a lot about the conversions towards the end, but could you just recap, can people convert money from a traditional IRA to a Roth IRA?
Yes. Do you want me to elaborate, or is that a good?
No, not at all. So the next session I have, guys, and I'm actually going to type a response that's a link to this. I'll put it in the chat box too. But real quickly, can we touch on the impact that Secure 2.0 has on, you think, the Roth catch-up provision, right? For people that make over $145,000 in 2023, effective January 1st, there's a new provision that is going to require those high income earners to use the Roth source for catch-up contributions. One of you guys want to highlight that? You guys want me to highlight that?
You're the retirement plan consultant. You want to take? I can add to it if you want.
So I did real quickly in the chat box. I did just paste a YouTube link. If any attendees want to pull that up in their browser to watch afterwards, it's only 5 minutes, part of our BFSG short series, where two of our colleagues actually highlighted this exact feature. But if you are one of those people that, like, the only group of people this applies to is people that are over age 50 and in 2023 made over $145,000. If you are saving Roth already for all of your retirement savings in your employer-sponsored account, all the way up to $30,000, it won't actually impact you because you're already saving all of your money to Roth. But if you have been saving all $30,000 to the pre-tax source in your employer-sponsored plan, what this provision is going to require is that your employer and you can only save up to the $22,000 pre-tax, and the first dollar after that, $22,501, all the way to $30,000, is going to be required to go to the Roth source. It's effectively, right, Congress saying, we're not going to let, right, all of these high income earners defer taxes for as long as possible. Like, it's a money grab. It's a way for them to, at least start getting some taxes on that $7,500, but still let you get to 22.5 pre-tax. Again, it's a really complicated provision. There isn't even a chance right now. There's a lot of petitions to delay this provision because there's a lot of complexities between, employers and payroll companies and the record keeping firms like, Schwab, Fidelity, Empower, et cetera, where your money might be held over. Like, how do we even do this? Like, what's the mechanism to flag that this needs to become Roth from pre-tax? But at this point, and it has not been delayed, so we are running on autopilot, assuming that it's going to be effective January 1st of this year. So again, I do encourage all of you to check out the 5-minute YouTube video that might articulate this a little bit easier and cleaner for you.
Just for clarification, January 1st of 2024.
2024, correct. So next thing is, so for, retirement account, 457, et cetera, since it's one account with 2 buckets, regular Roth, does the plan keeps track of the funds, which tax-free versus taxable, or do we have to do that? And the answer to that is yes. Wherever your money is held inside of a retirement account, either at, for your employer-sponsored account, the record keeper or custodian is now tracking pre-tax and Roth and all the earnings on that separately for you, so that you don't need to do that. And then when you get to retirement, you can pick and choose which bucket of money to pull money out of. The other question is, this is specific to 457s, do 457 plans have required minimum withdrawals? Yes, just like the 401k world, 403b world, and 457 plans all have required minimum distributions that start as of this year as age 73. There's an automatic step provision in about 10 years that will move that to age 75 unless Congress does something sooner. The next question I have here for you too is, I understand a non-spouse Roth beneficiary must still deplete the inherited Roth IRA within 10 years of the account owner's death. And this applies to inherited IRAs that the owner died after December 31st, 2019. Can you confirm that that's correct?
Yes, that was part of the Secure Act 1.0 passed in 2019, where they have to deplete that in 10 years. The IRS did provide further clarification just a few weeks ago that required minimum distributions are not required for this year, but will most likely start next year. So they do have to be depleted over 10 years. There was some confusion around, hey, can we just wait all the way to the 10th year and take that all at once? But the IRS is most likely going to require distributions annually on that, but starting next year. And they won't make they won't make you take retroactive RMDs, but it still has to be depleted by that 10th year.
So next question I have here is just to confirm, employees can defer money into their employer's 401k and put money into their separate IRAs. Like, let me add to that. What if somebody's already saving the max 22.5 or 30,000 in their employer 401k? Can they still contribute $6,500 to an IRA?
Yes, as long as you're under those thresholds right there on the screen.
Exactly. It goes back to the slide.
Yeah. So if you're single making 75 or under $73,000 and you're maxing out, I mean, you're saving almost a third or more of your income to your retirement plan, good for you. And then you're wanting to make additional contributions on top of that, you can.
It just, again, goes back to the tax deductibility that we mentioned a couple of times, of whether or not you can deduct it for taxes.
And so the next question I have here, group, is it sounds like this person's accounts with Charles Schwab. So I don't know if it's, like a employer sponsored plan or IRA, but it says, does it tell me if it's a Roth? So I think, at least from a 401k perspective, right, an employer account, yes, it will tell you if it's a regular pre-tax 401k or if it's a Roth 401k source. You will likely have both inside your plan. You'll have one balance, and then you just look at the money sources or money types, and it will tell you how much money you have in pre-tax and how much money you have in Roth. If it's an IRA, it will just tell you in the name of the IRA. You're right. And again, it will depend how you set it up. You either set it up traditional or you set it up Roth, but that would be two separate accounts, not one account with two monies. You would have a separate traditional or a Roth IRA. But yes, it would be in your account documents to tell you if it's pre-tax or Roth.
Yeah, and like Schwab or Fidelity, it's going to be right in the title, Roth IRA or traditional IRA or rollover IRA or something like that. Yeah.
Yeah.
So next question I got, gentlemen, is does the Roth 10% higher education penalty exception apply to a child's education as well?
Yes.
Yep. I like it. Easy one. So the next one is this just got a thumbs up.
Chad, before you move on, it's for family members it applies. So child, yes, like Arash answered, like if it's a non-family member, no. So just want to be clear on that.
Next question is, so we have income limits still on the page. Are those before or after tax income limits?
So there is a specific calculation. It's it would be that goes through this. So to answer your question, it wouldn't be before tax though.
Yeah, it's based on modified adjusted gross income.
Yeah.
So less certain deductions and so on.
Yep, awesome. Okay, next question I have. There's a lot of discussion about RMDs after age 59 and a half, and assuming you have held your Roth accounts for more than 5 years, are there any limits on what you can withdraw from traditional or Roth accounts should you need more than the RMD?
No, you can take as much as you want out of each and every year. Just again, on a pre-tax, you're going to pay taxes on those withdrawals above and beyond that.
Yeah, but there's no limits. No limits. Just on the pre-tax, if you really need the money, you could. But if it's not necessary, just be mindful of your tax bracket, so you're not going into a higher tax bracket and incur more taxes if you don't really need the money.
Yeah, we work with a lot of clients where there is that gap between retirement and before their Social Security kicks in, where we sometimes take out more than is required because they're in a low tax bracket, knowing they're going to go into a higher tax bracket in a few years. And so, yeah, you can always take out more than you need to.
Yep. And then, so next one I have here is, there's a 5-year rule that we've been talking about applied to specific Roth IRA accounts or to all Roth IRA accounts in aggregate. I think if you set up an IRA, 10 years ago, you set up another Roth IRA tomorrow. Does the new IRA fall under the original 5-year from the other IRA you set up, or does the new IRA have its own 5-year clock?
I think it's I'm not 100% sure. I'll have to check this, and if that person wants to reach out to us directly, but I believe it's on each one. It's not on another one, but I'm not 100% sure.
I think it's on each one as well, but we can get back to that one.
Yep, I agree, actually. So the next question I have for you is, are there RMDs for Roth IRAs, or can you just leave it in there indefinitely? So I think we answered this earlier, but just in case, can you guys clarify, because it does apply to Roth inside of retirement, like employer retirement accounts too? No RMDs.
There is no RMDs, but if once your beneficiaries inherit those Roth accounts, they have to do RMDs within 10 years, but there is no taxes. They just have to take the money out.
Yeah. So no RMDs for your Roth IRA or Roth 401k or Roth 403b. If your heirs inherit that Roth, there are RMDs, but they're tax-free, and they have to be depleted over that 10 years with the Secure Act of 2019.
Okay, so next question so the safe bet is just to contribute as much as you can to a Roth and just let it build till you retire. Is that what we're saying here?
We made the case for Roth.
It depends on your
Um,
situation, but taking advantage of a Roth account and incorporating that into a retirement plan is definitely beneficial. Let's just put it that way. I wouldn't say do 100%.
Yep. And then yeah, it depends, right? Honestly, I think at the end of your career in retirement, it's good to have some pre-tax money, right? It's tax diversification is a huge benefit. Like if every single dollar you own in retirement is Roth, then you pay taxes on every single dollar at whatever that tax rate might be. So you want to have pre-tax money, but again, Social Security will be pre-tax money too, though. So just things to think about is tax diversification is a huge thing in retirement that is very often overlooked. Is work with your accountant, work with your financial planner, and try to figure out the best way to bucket money and how much you want to have in each source. Like just blanket save every dollar Roth is honestly probably not the best idea because you want to have some pre-tax savings so that you can play and kind of balance your tax liability.
Exactly.
Next question is, so if I open a Roth IRA at my bank today and 5 years later, I roll over my $20,000 Roth 401k plan from my employer into the bank IRA, would I have to wait another 5 years before I could touch the 20,000K portion?
On a rollover?
Correct.
Yeah, no.
Not at all. So the rollover, of course, especially if that's already has 5 years as well, the moment you roll it into your other Roth IRA that already has 5 years, a rollover is not a conversion. A rollover is just taking money from one account, moving it into your IRA so you don't spend it, which is remarkably smart, right? If you distribute it from your 401k, you could have penalties if you're not age 59 and a half. So rollover is not the same as conversion and does not start a new clock on the money.
Correct.
So next question I have for you too is, I'm pretty sure that we said earlier that beneficiaries of Roth accounts do not have to take RMDs. Now we're saying that they have to withdraw in 10 years.
Yeah, it's kind of a gray area because the IRS is made a comment last year. They clarified as saying, hey, it's being delayed to 2024. So most likely, as IRS provides further guidance, RMDs for your heirs for an inherited Roth IRA will be required to take an RMD and have to be depleted over 10 years. But again, there's no taxes on those amounts. They can't continue just indefinitely to hold it in a Roth IRA for their whole life, give it to their kids and so on, and use it as a perpetual tax-free. The IRS does not want that. Congress does not want that.
Okay, so the next question I have here is, well, I have an IRA. This one's at Fidelity, less than $4,000, 63 years old. Should I convert it as a Roth at this point?
Depends on the situation, your taxes, your financial, can't really say.
Yeah, they can reach out to us and we can talk to them and look at their situation.
Yeah, again, it all depends on your income this year, right? So if your income is relatively low tax bracket, it's not a bad thing. But again, you also need to have the cash on hand outside of that IRA to cover the tax bill, right? You can't take money from this account to cover the tax bill. So again, it does depend on what you have going on in your own situation.
Well, to clarify, you could use it to cover the taxes, it's just not beneficial because you're losing that capital that could transfer over.
Okay, next question is the spousal IRA, there's supposed to be a non-working spouse, but what is considered a non-working spouse? Like, what if that non-working spouse gets 1099 income from working part-time as an independent contractor?
Spouse, sorry, I have to read the question again.
Yeah, I told you we had some good ones coming in. Basically, does contractor income count as working when you're thinking about the non-working spouse?
Yes,
Income?
yes. That's not a non-working spouse. Contractor income is earned income.
It is.
That is not non-working.
Yeah.
I had to read that one too.
So the next one is, I set up a Roth IRA 10 years ago with a credit union and just set up one inside my city's retirement plans. Does a 5-year apply to the original contribution 10 years ago? I think we answered this one earlier too. Yeah, they do have different 5-year clocks, right? So your city's employer account has its own 5-year clock. The credit union has its own 5-year clock. Yeah, I think, Mike and Arash are going to try to confirm that. I think all three of us collectively, that is everything that I've read in the past, is that different accounts have different clocks.
Yeah.
The next one is, just consider an example here is an 88-year-old holding no qualified accounts, so no IRAs, Roth, etc. However, very cash heavy in traditional savings, call it 300K, own the house outright. Do you think this person able to contribute to conservative Roth IRA up to 22.5 each year and then not withdraw for 5 years? So this would basically be for purpose of avoiding tax for heirs exclusively, right? Is that kind of what we're saying?
If he or she is working and there's a plan at work, that then yes, but if that makes sense, because you have to be working to be able to contribute to a plan up to 22,000. If say you're thinking about the Roth account, again, you have to have earned income to be able to contribute. So there's all goes back to whether or not you have earned income.
If you're 88 and working, go for it. That's congrats to you.
Okay, so next question I have here is, if I leave my employer and I have a traditional 401k plan, and I cash out this plan after I leave and I pay the maximum tax allowed by the employer at the time of withdrawal, can I then deposit those funds into a Roth IRA since the taxes were already paid?
No, not, yeah. To do a conversion, you have to, follow proper procedures and paperwork. You can't make a contribution or withdrawal, pay taxes on that, then put it back into a Roth without earned income. It'd be a new contribution. It's not a conversion.
Yeah, let me clarify that a little bit.
If you have earned income, then you can. If you have earned income, then you can put money in there how much you want, but up to your earned income limits for the Roth IRA. So if you're under 50, up to 6,500, as long as you have that much earned income.
Yeah, I think the important one there too, just to clarify, is in an IRA, even assuming you're over age 50, you can save $7,500. If you cash out like a $50,000 traditional 401k plan, then you pay the taxes on that. If you're over age 50 but not 59 and a half, you're also paying the penalties, right, of 10 to 12.5%, depending on where you live. Now that's basically an additional tax that you wouldn't have had to pay if you just put it directly to the Roth IRA or to the traditional IRA in the first place. So the best approach would be to roll it to your traditional IRA instead, out of the employer plan, traditional IRA, and then convert it from traditional IRA to a Roth IRA, and you get the entire amount without paying that 10 to 12.5% penalty. Again, the only negative is you need to have the cash somewhere else to pay the taxes, but I don't know that it's worth paying 10 to 12% in penalties just to have cash to drop $7,500 into a Roth IRA, if that makes sense. That seems like a pretty hefty fine just to put $7,500 into a Roth IRA. Next question is, I have extra money from my home sale. How can I deposit it to my 401k?
Well, if you're working, you could go maximize your contribution to 401k, then use your extra cash for your expenses. That's the only way you could really do this, because it has to go from your paycheck to the 401k.
Yep. Yeah, it has to be a payroll deduction. So you can work with HR or on your platform to change your withholdings, just withhold more of your paycheck to go to your 401k and then just live off those savings.
So the next one is, I have $20,000 in an employer 401k. Can I convert all of this to a Roth IRA at once? This one is, it depends thing too. Is number one, could you move it all to a Roth IRA? It depends if it's pre-tax or traditional, just like the last question we asked, right? You might have to go to a traditional IRA first and then convert it. The other thing is, you can convert it all at once, but do you want to, and do you have the cash to pay the tax bill separately? And then the last piece of that is this an existing employer or a prior employer, right? Retirement account. So if it is your existing employer's 401k, you cannot take it out until you terminate employment with that existing employer. So just a couple caveats, but assuming it's a former employer, again, you can convert it, but you would want to go to traditional IRA first and make sure you have the cash. I would definitely work with your accountant and your financial planner to make sure you don't convert too much and boost your tax bracket, which we've talked about quite a bit today.
Chad, you want to just clarify too on conversion within a retirement plan? If that's they're able to and
Yeah,
not kind of.
that's a good one too. So I mean, even if it's your existing employer, especially, is before you decide to take it out and move it over to a Roth IRA instead, some plans, not all plans, again, this is an optional thing that not every employer has turned on, but some 401k, 403b, and 457 plans have turned on the ability to do in-plan Roth conversions, which means you don't need to actually take it out of the plan and move it to an IRA. You can just take it from traditional to Roth in the plan. Again, it is still irreversible decision, and you still have to figure out how to pay the tax bill from cash outside of that account. But what it doesn't make available is the ability to keep the money inside of your employer-sponsored account, which in many cases have relatively low fees compared to what you might pay in an IRA, right? IRAs, the investment options are typically more expensive than your employer-sponsored account because your employer-sponsored account is access just to the share classes and versions of the same mutual funds, but have lower expenses because they have all of your employees' money in aggregate as opposed to just your one account. There also is usually asset allocation tools, right? Like ways to invest it in assistance investing it that are relatively cheap rather than putting it into an IRA and then hiring an advisor to manage it for you that might charge you upwards of 1%, right? So a lot of things to consider before you take it out of an employer-sponsored account and put it into an IRA is, what are the difference in fees? How is it going to get managed, et cetera?
Yep.
So the next question I have here is, so once again, just going back to credit union, do not put our Roth money to credit union. Can you tell us where to put it and roll over to a new one?
So it's not about putting the money in a credit union or any other institution. It's about that money is invested. So you just, if this is the same person asked a previous question, you just have to reach out to them to see how they are invested these funds. Otherwise, you can open a Roth account in a credit union at any major bank or at the brokerage firm or anywhere. It's just a matter of how it is invested.
Yeah, if you're a credit union, I mean, you can most likely invest in stocks and bonds there as well. Just be aware of what fees you're paying. They may be charging commissions and other fees, so be aware of what products they're placing you in.
So next question I have here is, this person is 37. In our opinion, will there still be Social Security by the time they retire? If they keep hearing it's going to be gone.
Hopefully they were able to join us on the first session of the summer webinar series, but we have some good blog posts as well on our website where we've touched on this. I think we just did a recent one in the past month. Opinions differ. My opinion, yes, it will still be there. Will it be in the same, will it look the same as it does today? Most likely no. Last time they made changes to Social Security, 1982, 83. People younger than age 50 had changes to Social Security. That's when full retirement age went gradually up to age 67 and other changes as well. I would assume when they finally make changes to Social Security, which again, they'll have to, because we're going to have a shortfall here in the next decade, they'll probably set again an age kind of threshold of changes. So 37, yeah, probably. But it will be there for you, I think.
Yeah, there definitely will be some changes, but hopefully they'll be there because I'm 37 too, and I'm banking on that as well.
So the next question is, I just found out that my firm has Roth contribution option in our 401k. I built up a heavy traditional 401k account over the last 20 years. I mean, am I able to convert the traditional portion of the 401k account to the Roth side? Of course, strategically, it won't bump me into a higher tax bracket. And so I would do this ladder every year, is what you're suggesting? I think the answer to that is
you can make contributions to both. So you don't have to make hey, this is all 100% pre-tax this year, all 100% after tax the next year. You can do both and manage your tax bracket and what's most beneficial to you. So I'd say work with your tax professional or financial planner.
Yep. The next one is how do we feel about cryptocurrencies?
Not touching that one.
What I can tell you is, I mean, I invest crypto. I think everybody in our firm has different opinions here. You be careful, make it a small piece of your portfolio. Don't put all your money in there. You're either going to get lucky or you're going to get really, really hurt. But this does say, what about the ability to invest in a retirement account, in a retirement plan? And I think Fidelity's made that available. What I can tell you is the Department of Labor has basically came down and said to all employer-sponsored plans, do not allow cryptocurrencies. Some employers have self-directed brokerage accounts that are available inside of the plan, and right, instead of just the normal mutual funds. There are ETFs, and there is a mutual fund that would allow you to actually get access to those. What I can tell you is the DOL has basically said if we're going to come audit you and these are not suitable, and that employers should require their employees, if they want to buy crypto, you can buy it, but not inside of the employer retirement plan. So there's more guidance. It's just really hard for employers to completely restrict that. What I can tell you is that it's going to be a long time before an employer makes it a core fund option that's very easy to get into, right? There will be hurdles and hoops you'll have to go through to be able to access that type of product inside of your employer retirement account.
I mean, the volatility is just huge in cryptocurrencies, and I can't imagine a retirement plan putting that in and someone accidentally going 100% in cryptocurrency and losing all their retirement plan savings if that were to happen, or just have huge swings in volatility.
Definitely, it's definitely a speculative asset that you want to be very cautious about. I mean, the technology behind it, the blockchain will be around, is getting adopted, but as an investment standpoint, if you're saving for a retirement plan, you may want to be very, very careful on that one.
Yep. Okay, and then I got this comes back to the RMDs. IRS states that RMDs were already started by the descendant. Then the recipient of an inherited IRA has to take RMD over the 10-year depletion period. So really what that means is whether it's an RMD or just 10 installments, at the end of the day, that account has to be depleted within 10 years, no matter what.
Yeah, and that's a right comment from that participant. Yep.
And then so the last one I have here is, I think this is specific to one specific employer. So just as a note, does our employer allow non-Roth to Roth funds conversion in our 47 plan at Empower? Please do reach out to us directly. You have the contact information on the page for Mike and Arash. You'll also have mine in the emails that you receive from us. This is a national audience that we have that has a lot of employers that are clients of BFSG that all sent the invitation to their employees and plan participants. So with this, I can't say which employer you work for from that question. So please do reach out directly. We are happy to answer that question and do the research if we need to and we don't know. Either way, everybody, any closing remarks from Mike and Arash?
I'll take that final question, one that got in the last second, Chad.
Oh, yeah, I see it.
Okay, the 457 plan. Do I have to start taking money from my Roth IRA at a certain age, like an employer 457 plan? No, you do not. There's no required minimum distribution for your Roth IRA.
Yep, of course. Awesome. Thanks, everyone. Thanks for your time today, and we hope you all have a great afternoon.
Yeah, thank you, everyone.